What is happening, best ever listeners? It's Matt Faircloth, and welcome to the Best Ever CRE show. My name is Matt, as I said, and this is my segment called Next Level CRE, coming at you guys every Friday. So mark your calendar, write it down, and do us all a favor here at Best Ever. Like this show. I like it. You should like it too. And add it to your subscription base, right? And tell a friend about this. And guess what? Today, we're going to be getting into some really crazy conversations about scale. And so if you are looking to go to the next level, beyond the next level in your multifamily business or your real estate investing business in general, or if you know someone who's going to the next level that owns a couple duplexes, a couple triplexes, and they keep complaining to you they're not growing enough, and you want to inspire them, send them this interview because it's going to be an inspiring next level. Reach through the podcast microphone and shake you up a little bit, teach you guys how to get to the next level. And what better friend here to come talk about the next level is a good buddy of mine that I've talked about a lot of scale with, been through a lot of ventures with, done a lot of masterminding with, my good friend, Michael Blanc. Michael, how are you?
What's going on, Matt?
It's great, man. I'm great. So let's talk a little shop about scale with the best ever listeners. So quick intro for those that don't know you. Here's what I know about you. You're great, man. You're fun to hang out with. You got a big heart. You're originally from Germany, I think. So that's a fact that it's fun to talk about. We don't have to get into all that, but I know that's fun to talk about. That's why it's not pronounced blank. It's blanc. You got to get some culture in. You say it the right way. Former pizza franchise owner, now real estate entrepreneur. And I've learned a lot by watching you and learned a lot from you and your communities. What did I miss, man? What other intro do you want to throw out there to anybody else?
I think my life really materially changed when I read Rich Dad Poor Dad, and maybe for you as well. And it threw me for a loop because I thought I was a smart guy, especially with regards to money. And after reading that book, I felt like such an idiot. And it like 3 months later, I quit my job because of this book.
Wow.
Yeah. Yeah, I mean, I came home and told my wife I quit.
That's the soonest window. I quit my job after reading Rich Dad Poor Dad, but it wasn't until years later. I don't have the cojones that you did. So you quit. What was your job before you?
I was in a software company, and I was a manager. When I joined in '97, I was the third employee of this company called Web Methods, and it went public in March 2000. At the time, we had like 1,300 employees. So we went in like 3 years. Went from zero revenue to $200 million in revenue. It was a wild ride. And so I had a software background. And so I walked away from that in 2005 and in pursuit of financial freedom. And so my big idea, as you mentioned, was a pizza franchise. It wasn't real estate at all. Though I flipped a couple houses, but it was like this thing I wanted to do. And I traded stocks and options for 18 months. Yeah. So I just learned how money works. And I did everything.
Were you an engineer by trade? Did you go to school for engineering?
Software engineer. Yes, I'm highly educated, man. I have a master's in computer science that I threw away in 2005.
Right. No, and the reason I ask is that I cannot count. I've lost count of the number of former engineers. I call us recovering engineers. I was an engineer by trade. Our good friend and mastermind compadre, Andrew Cushman, is a engineer by trade. You are. I can't name all. I think Reed Goosens as well is a engineer by trade too, and keep going down the list. All these folks were. Why do you think? I've asked other people this too. Why do you think the engineering brain works so well in real estate investing?
I think we're the people you mentioned. I think we're unusual engineers, and so I'm a little mixed on engineers. Me being one of them. But the problem with engineers is they're too overly analytical. Yeah. They have to have everything laid out just so before they will take action. So they're very cautious. Yeah. And as you know, if you want to become an entrepreneur, that does not serve you. On the other spectrum is the people who just are bumbling idiots and they just kind of take action and they screw things up. But my observation is the people that do that, they're going to be more successful than the over-analysis type engineer. So if you're an engineer, you got to overcome that sense of uncertainty about not having everything set up. And so I must have that. You must have it as well, because as an entrepreneur, you have to deal with some amount of uncertainty.
I think that engineers also, in my 2 cents on it, they're able to look at a complex enough system that's got multiple variables and kind of figure out what matters, what doesn't, and how to solve the equation, so to speak. In real estate,
that's the strength of an engineer. Exactly right.
I think real estate investing in some ways is an equation. What do you have, right? You got a market, you got interest rates, you have, revenue coming in from some sort of rental income, whatever that may be. And there's plenty of other things in the equation too. And you solve for the bottom line. There's a lot of variables, but some don't matter as much as other ones do. So it's also important to put weighting on certain factors and everything like that. So maybe that's what it is. And there's certainly math involved in real estate investing too. So you got to have a background of a little bit of math in there too.
The downside of engineers and a lot of people is that I used to have a do-it-yourself mentality, right? Because I'm smart. Right?
Yes.
Where engineers are smart. And the problem with being smart is that you know yourself, that you can figure everything out. And that's exactly what I did. And I lost years. I left millions of dollars on the table because of this innate need to figure things out, which of course is stupid, as we now know. I don't know if you're affected by that, but I certainly was.
Sure. I'm stupid all the time. What I would say, here's what I think, like tying this into early stage real estate investing for all people, right? And they all picked up the little purple book. I cannot tell you how many people I've interviewed on here on Best Ever and on Bigger Pockets that told me, oh, I read Rich Dad Poor Dad back in 2005, 6, 7, and then I got into real estate investing. As I'm sure on your show, your podcast, many people have had the same story. But for one reason or another, they get in. They buy a duplex, low money down, that kind of thing. And that gets them in. And they get into and it's not a trap, but it's level 1 real estate investing.
It is a trap.
Yeah, it is a trap.
It is a trap.
Okay, do tell.
Yeah, I mean, it was a trap for me. The problem with the Purple Book is it puts a crazy thought in your mind, which is passive income, financial freedom. That's wild. Just the idea is wild. But it's kind of largely silent on the actual strategy, right? So it just it uses confusing words like real estate or cash flowing businesses.
Yeah.
And so the readers left to their own devices and said, everyone, real estate, well, obviously it's flipping rentals and then maybe wholesaling possible. Flips and rentals. Why? Because most people live in a house or apartment, or they know someone that does. And everybody on HGTV is flipping houses or following some kind of Burr method. Okay. So real estate investing is automatically single family house investing.
Yes.
That's it. The problem with that is, and people listening, watching this, if you've done a flip or rental, it actually doesn't lead to financial freedom. Yeah. Okay, it doesn't. Like a rental, as just simple math, a rental generates what, $200 a month if you're lucky?
Maybe.
So maybe. Well, you need $10,000 a month. You need 50 of those.
Yeah.
Okay. Well, that's. Have you thought about that? Most people haven't.
How you get to 50? Yeah.
Flipping. Right. Well, flipping was my way, right? Flipping. I flipped 3 dozen houses in 3 years. And it took me 3 years and 3 dozen houses to realize that it was actually a lot of work. There was nothing passive about it, right? And most people that I knew could, take 6 months to flip a house. And so you can do one at a time. That's 2 houses. Let's say your target back in the day in 2000, whatever, 6, 7, my target was $25K. Now it's more like $50K. Okay, $50K. So I'm doing 2 a year. That's $100,000. First of all, it's not passive and I'm not making millions. It's not a wealth building mechanism. No. Right,
it's not tax leverage either. It's not
tax leverage either, right?
So flipper I know takes it on the chin, man.
So now reconcile this experience with what Robert talks about, and a lot of people are just scratching their heads. They're going, "What the heck? Something is broken. Yeah. Something is broken."
Well, here's what I think. Did you read his cash flow quadrant book, the ESBI book?
I have.
Okay. Here's I think the misunderstanding that real estate investors have. Right? They think. Those that read the book think that, if I go buy a couple of rentals, I'm in that coveted I quadrant. Oh, I quadrant, yay. They're not. You're not. Nope. You are a solopreneur. Couple of rentals puts you in the S quadrant of investing. That means you are a solopreneur. You get hit by a bolt of lightning. So does your rental portfolio, right? Because you're probably out there doing some of the work, if not all the work, if you don't have a property manager. And you're left to your own misunderstandings, your own engineering brain, or I don't know if you've had anybody that you've worked with, Michael, that God forbid is handy. Oh no. Like you take a real estate investor and are you handy? Are you a handy kind of guy?
I can be. Yes. I know where you're going with that. Like, because same with engineer, they're going to try to do things themselves because they can.
Sure. Yeah. I don't know the right way to turn a wrench. I'm not sure.
Good for you. That's great for you.
Yeah, it is. But I've had buddies that have rental properties. They're like, oh yeah, toilet clog, no problem. I'll knock that out. Right. And that's the trap too. That's the trap in that like a small portfolio of rentals can suck you in to whatever blind spot you got that you carried into it from life. Right. So they don't realize they're in the S quadrant. What I have learned and what I think that you and I talked about offline is the idea that what they want bigger portfolios. Right. But they do like they really realize into it, as I did with a couple of rentals. That was my story, yours too, that I want something more. I want real checks, real passive income, something I can start to scale, and buying 50 single family homes sounds like brain damage. I'm not going to do that. Right. So they want to build a B quadrant business from the ESBI. It's what they realize. You're not going to be I is our investors, people that invest with DeRosa Group and Nighthawk. Those are people that write fully passive checks. That Kiyosaki doesn't get into is OPT, other people's time versus your money, right? But if you want to build a business, you got to build something that's able to attract I quadrant investors and outsource yourself, from the center of it. And I think a lot of people miss that. That's probably the pain of scaling for a lot of people. What do you think?
Well, it is, and here's the problem though, Matt. Is a lot of people when I say okay, but the solution is commercial real estate and raising other people money, they're like, yeah, I know. And so the question is, well, why don't they do it? And they do it because they have preconceived notions in their head. 100%. And I certainly had that because I learned back when I left my job. I took all these boot camps and seminars. I took a commercial real estate investing class, and so I knew about this thing about commercial real estate. But I didn't actually get into it for reals until like 2017. I accidentally got into one in 2011, but I didn't actually turn to a strategy because I got so sidetracked with single family house investing, because in my mind, apartments or commercial real estate in general is a very advanced strategy. I needed to have at least a decade of real estate investing experience, number one, which I didn't have. I felt like I needed it, which you don't. And number two, I didn't have the money.
Yeah.
And even though I knew about the idea of raising money, there's no way I thought I could raise $1 million to buy, $3 million apartment building. Right. So to me, it was like later. It was like this deferred thing. Let me build that. Let me do some flips. Let me build a portfolio of rentals. And a lot of people are like that. And until they realize they can't get there. And then there's usually some kind of life event, like their 3-year-old daughter or something like that. And, they realize that they're working too much. And they're going to be working in their job another 30 years, and they don't want to miss their kid grow up. And they go like, I need something faster.
What was your life event? Did you have a light bulb moment for yourself that was like, oh wow, okay, this is a whole nother thing?
So for me, the light bulb moment was when I read that book and I kind of thought things through. And I was like, at the time, I had a 2-year-old and a 3-year-old, I can't remember, something like that. And I just turned 30 or 31 at the time, and so. I had 10 years of working experience, and I was like, dag, I need to work another 30 years before I can retire. Yeah. Like, to me, I was like, holy cow. Like, this just didn't compute for me. So it wasn't a life event per se, but it was like looking forward into the future. And I was like, I don't want to do that. Like, yeah. I mean, maybe I do, but I don't want to be forced to do it.
Yeah. But what was the life event? Was there another aha moment that you had that you're like, you've got the fix and flip business going, that's kicking your ass, and you're like, wait a minute, this is like absolute work, pizza franchise, good experiment, no thanks. Like at some point you jump into the multifamily pool and create a lot of success for yourself. Was that the same pivot point we're talking about?
No. Okay. So on the one hand, I'm a fast learner, and on the other hand, I'm a very slow learner. Like I'm a very experiential learner, which doesn't make you very wise, right? A wise person learns from someone else's experiences. I, on the other hand, apparently have to bundle through it. And I sometimes call myself the crash test dummy of financial freedom. Yeah. So me, first of all, I had experienced the pain of flipping 3 dozen houses. Well, that's stupid. I could have just thought through it. Now, luckily, I skipped the Burb portfolio. That to me was really actually dumb. I did some math on that one. Okay. And then the apartment building thing was by accident. One of my wholesalers brought it to me. So I kind of just got into it because I felt like I could, which I couldn't. I screwed it up almost pretty royally for about 18 months. I ran out of money. And then finally the whole thing stabilized, and it was sending me $1,500 per month in mailbox money, which was super boring. But that's when the light bulb came off for me. It's like, oh my gosh, I got these 12 units and it's $1,500, and I wanted to get to 10,000, right? So all I need is another handful of these buildings So why the hell am I flipping all these houses?
Yeah.
Like, why don't I stop doing that and start doing more of that? And so, again, all unnecessary. It's years and years of experimenting on myself versus actually studying the material, studying the matter, maybe talking to people who have actually successfully done what I want to do. And well, what do they do? Well, how do they overcome those things? Like, what was the light bulb moment for you?
No, that's it's so crazy, man. You had a very similar path, engineering, about the same year, getting into the business and all that jazz, right? Wish that poor dad. So for me, I had a portfolio at some point. So we did have investors at the time, but my only playground at the time was Trenton, New Jersey. So I owned a lot of small multi, like duplexes, triplexes, and I was scaled out, vertically integrated. I owned the property management company that ran all those assets, and I had a team that was doing it. And I was doing a lot of the work too. And I was making an okay living running 115 units out of Trenton, New Jersey, but it was a grind. I mean, it was like Monday through Friday, 9 to 5. You know, if the heat went out at one of our properties on the day after Christmas, and I'm on vacation with my family, and I get a phone call, and I got to deal with that because I didn't have the infrastructure built out deeper to deal with it. So it was very involved, but it was enough to make a living off of. Then opportunity comes up that we want to start scaling up. We start offering opportunities in Trenton, New Jersey to new investors that are showing up, and they're like, nah, not Trenton. Nothing wrong with Trenton, but just they wanted to be somewhere else. So we started shopping. So we found an 18 unit in Philadelphia. And we raised enough capital. We eked across the finish line and raised $500,000 to buy that 18 unit apartment building, 50% occupied, filled the rest of it up. And before I knew it, that one property was paying my company more in property management fees and in cash flow than the entire rest of the portfolio.
Wild. Absolutely wild.
And I was like, holy crap, here we go, light bulb. And it wasn't just not Trenton. It was just, like small, like larger multi, the rules are easier to implement and all the units are the same. I can like keep in the little maintenance storage room. I can keep the same paint, the same tiles, the same everything. And my engineering brain kicked in and I thought of it like a factory, Michael. I'm like, hey, this is something that I can duplicate process on and I can do over and over and over again, like McDonald'sification. Wow. So before you know it, it went from that 18 unit to a 49 unit to 198 unit, and then off to the races from there. So that was my light bulb. Yet again, like you, just stumbled into it. I'm your crash. I'm riding shotgun in your crash test dummy thing. I've done all the mistakes and all the battle scars and bruises. And for a lot of the folks that I've coached, I've taught like, hey man, just here's the deal. Don't do what I did. Here's how you do it the right way. So yeah, that's scaling. That's when the light bulb moment hits, right? It sure is scary. What do you think are like the expansion pains for the students you've talked to that have hit that light bulb? Like, okay, I want something bigger. I want something greater. What's the most common things that stands in these folks' way when they hit that moment?
Yeah, it's pretty simple. It's a lack of a scaling mindset, and the scaling mindset is completely different than a single family house investing mindset.
Yeah,
single family house investing mindset is all about you. Right. And it certainly was about me. I'm doing everything. I have to figure everything out myself. I have to rely on my own resources. And that's cool for my ego, maybe, but it's really not conducive to scaling. Extreme case, Elon Musk, right? Yep. If Elon Musk had a do it yourself kind of mindset, he would not be able to do what he's doing today. Right. He wants to go to Mars, and he already knows because of the scale of the mission that he's going to need help. Right. So he's a pretty smart guy. He already knows he can't do it himself. And it's a scaling mindset is the same thing. So instead of thinking that you have to do everything, thinking you have to know everything, thinking you have to have everything, instead, it's more like a who, not how mentality. So it's this book by Dan Sullivan, Who, Not How.
Love that book.
I mean, I've always felt this for a while, but when I read this book like 3 years ago, it's been around for longer than that, but the title says it all. But it's a fundamental shift in your mindset. If you have a who, not how mentality, you stop asking, how do I do something? And you start asking, who can help me do something, or who can help me do something for me? It's totally different, right? Yeah. So, simple as, oh my gosh, how am I going to raise all this capital? Well, it's the wrong question. I mean, yes, it's useful, potentially helpful to know how to do it, but the bigger question to ask is, who can help me raise money? And the answer is, well, it could be an advisor, or it could be an actual capital raiser, right? Because there's a lot of people who have access to capital, and they're naturally suited from their personality to talk to people and raise money. But what they don't like is They don't like the numbers. They don't like all the analysis, right? And so those are what we call more of our deal finders, and they need each other, right? So it's this who, not how mentality. Oh, if I'm a capital raiser and I'm a high level relationship person, now I guess, well, how do I analyze this deal? You're asking the wrong question. Like, how am I going to talk to brokers? It's the wrong question. Who can help me do those things? In fact, who can do it for me? And when you start asking these questions, you're getting into the world of putting together a team of professionals, putting together a team of advisors, putting together a team of partners in a way. And now you are basically orchestrating something. And now you're talking about scale. And to me, it's much more interesting. It's more enjoyable and frankly, a lot less work at the end of the day.
Brilliant. I love that, because we're really left to we don't realize the blinders we have on as humans in some ways, right? Like, we don't see beyond our own face, especially if you're, a onesie twosie, no offense, best ever listeners, but, small single family duplex, maybe some success, maybe a couple dozen units in that size. You don't realize what's actually holding you back. And it could be you holding you back because you're operating at your own capacity. Maybe you don't want to raise capital, don't know how to raise capital, whatever it may be, or you don't know where the deals are, you don't know how to find deals, you need a deal finder. All those things are likely in your way. And when I scaled, I had to partner up with people that were able to bring things that they were better at to the table. Like, for example, Michael, I bought a fourplex when I was operating in Trenton. It was one of my very first deals. Underwrite the whole deal myself. I forgot to put in a significant line item for maintenance and buying it. And I bought a building that was built in 1960. As you know, those things, that's the thing. Like, it's like people born in 1960. They need a lot of attention, just like buildings built in 1962, right? So that building needed a lot more money than I had in my budget, because I'm not an underwriter. But aligning myself with people that knew how to build real sustainable business plans for real estate properties are ones that I needed to align myself with, because I can raise capital, but you don't want me to write up the plan. Again, my engineering brain can understand their plan, but you want me writing it. So those are great examples. Is the most common when you hear raising capital that you hear for people when you work with folks?
I would say so.
Yeah.
I would say, and this is paradoxically some of the easiest thing to overcome. If you have a more of a capital raiser personality, if you are an introverted engineer, let's pick on the poor engineers, you may struggle. You may struggle with this a little bit, right? But you're going to naturally gravitate towards numbers, and even speaking to brokers, even though you don't really love speaking to people, the matter is numbers, and you're comfortable with that. So deal analysis, that's detail oriented, possibly even managing something, and so therefore those people are going to resist raising capital. Now, the capital raisers personality, they will resist in the beginning, but only because they don't have the playbook. Yeah. They have questions like, well, how do I find my investors? What do I say to them? And then once they see it, they're like, oh, I got it from here, because they're naturally already talking to people. Yeah. So what people have found is that, like, for example, our students, like 100% of our students do not want to raise money. They resist raising money. They don't know how to do it. They don't want to beg their friends and family. They don't want to lose their money, all these things. And what they find is, once we actually force them to do it, because we have a certification process. That before they get certified, they have to speak to at least 5 potential investors. And once they get through, they're like, it's not so bad. Yeah. I'm still talking to them. I'm still breathing. And one of them actually was interested in investing with me, right? Yeah. And so all of a sudden, they're raising $500,000 in 60 days because of that. And so in this market environment where deals are a little harder to find, for example, it's actually a lot easier to raise capital in some sense. You put that together, and the raising capital part is actually almost easier than finding the deal.
Such great, nuggets I want to unpack. I want to point, underscore, play highlighter and underline a few things for you, best ever listeners. Okay. Number one, what's standing in your way and who can do it for you? Who, not how, right? Number two, about the raising private capital stuff. If you have not raised capital before, I talk about this in my book, Raising Private Capital, that if you haven't raised capital before, when you start talking to people, you realize a underlying fact: they need you. That, like, they don't realize that there is another place to make money for themselves. They think that Wall Street is the only place to invest and build your financial future. It can be one of them, but it doesn't have to be the only one. And so that's the bottom line, best ever listeners, is that they need you. So I love Michael's homework there. Go talk to 5 different people in your network. Tell them about real estate investing. And what's standing in your way and who could be doing it for you. Love that. I have a question for you, Michael. When you talk to folks about when you see that expansion point that people are at, when you got a couple duplexes looking to get to the next level, is the fact of them having some sort of a day vocation something that stands in their way, or are they able to expand while they keep a day job going? At some point, does the time brokerage become too much?
Yeah. So what we tell our students is 5 hours a week minimum, which is not huge, but it's still 5 hours. I mean, like a lot of our people that work with us, they're successful, professionals, whatever. And so 5 hours can be a stretch, and sometimes they complain about it. Yeah. To me, though, it's not a time management issue. It's a priority issue.
Yeah.
Right. If you have a full packed day, you got lunch, you got meetings, and all of a sudden you feel this sharp tooth in your mouth, and it gets worse, and you got to run to the dentist. You're going to cancel your meetings and run to the dentist. Why? Because it's a matter of priority. So to me, it doesn't come down to time management. It comes down to priorities. Is it more important for you to watch Netflix or play a video game, or is financial freedom maybe more important? If financial freedom is more important, especially if your spouse is on the same page as you, and now you're like, we're going to do this thing. It's going to take me 1 or 2 years to build this thing up, and I'm going to quit what I'm doing. And therefore, now we're building wealth for ourselves, and I can be home at 2:30 in the afternoon if that's what you want and what I want. Then what do you think? Right? And if you're on board, you are going to do whatever it takes to get that thing done. So it really comes down to priorities and how much you value financial freedom.
Absolutely. I think that's interesting. And like, by the way, I had the tooth thing the other day. I had my tooth started hurting real bad, and it ended up needing a root canal.
I didn't know that.
Great getting old. Yeah, I know you threw it out there. I thought you were talking to me. Like, it's lovely getting old. Yay. But like, as you said, I stopped what I was doing. I canceled appointments. I'm like, okay, we're going to put this to the very front of the line because this stinks having tooth pain, right? So maybe treat your desire for financial freedom or for a better financial position as bad as you would treat a toothache, right?
Well, it's a pain versus gain thing. I find especially successful people, 6-figure earners, whatever, the biggest problem they have, Matt, is they are in a good spot. They're comfortable.
Yes.
You're comfortable. And when you're in your comfort zone, oh man, it is so hard to get out of it. It's so hard. Why bother getting out of your comfort zone? Of course, everybody, abstractly knows that you can't grow in your comfort zone, right? You only grow in your growth zone, which is just, in my opinion, just outside the growth zone, the comfort zone. Yeah. But that means you have to leave your comfort zone a little bit. And a lot of people, they have a great income, great house, healthy, great family, nice car. And they're like, I don't know. I'd have to now do something uncomfortable. Like, I want this financial freedom thing, but now I got to learn something. I got to take on a little bit of risk. I got to talk to people. I got to even consider a partner. And they're like, I don't need it. I don't want it. And they stay in their comfort zone. And I just find that it just holds a lot of people back who tell me they want financial freedom, but they really don't. What they really want is they want to stay in their bubble.
Yeah. Well, they're afraid, right? I think there is a fear factor.
Why did you exit your bubble? Because you were in a bubble.
I was.
You were in a little comfort bubble, and a little ooze of comfort.
In with my day job, within your day job, sure.
Yeah.
Well, because my job sucked at the time, I did not like what I was doing.
So maybe not such a comfort bubble.
Yeah. Well, no, it was good. It was a good paycheck, but it was like Groundhog's Day, kind of a grind, and it was working like big Fortune 500 corporate, and there was like awful like sales reports you had to do, and Big Brother was watching, and just you had to go and speak to do the company shtick, and I just felt like I was selling out a little bit every day. I just felt my soul oozing out my ear, and if you wanted to climb the ladder in a big Fortune 5 company, especially I was a salesman for Ingersoll Rand. It's like a big a big equipment company, right? If I wanted to go to the next level from the sales territory that I had, I would have had to move 100%. They would have wanted me to move to a new place. And I kind of liked where I lived. I kind of had this girl I liked named Liz and everything like that. I kind of had things the way that I wanted them to be. And I was like, I kind of like living on the burbs of Philadelphia. This life feels good, but I want more. And I can't get it through Ingersoll Rand because they're going to move you to like San Antonio. And I don't want to do that. I don't know anybody in San Antonio. So I wanted to live life more on my own terms, even though I was inside my little bubble of comfort. And I think that it's interesting for anybody, for a best ever listener here, is that, you got to ask yourself that question about risk versus security. Like, is the security you have okay enough to the point where the life that you got is good enough that you don't want to take any risk to live a bigger life. I would argue with you that almost always it's worth it, even though it's going to be harder. There is joy in the difficulty of it. But some would say it's not, and that's okay. I get that too. So Michael, somebody's made the decision they want to scale up. For me, I found it to be a bit easier than I thought it was going to be. When I reached out and grabbed that 18 unit, I'm like, okay, I got this. This isn't that much harder. There's certain ways you have to learn about an apartment building. What are some of the folks you've worked with, or what have you seen in your own growth? Things that you thought were going to be hard that are actually easier than we think that they are before you cross that bridge.
Yeah, I think the biggest thing is a scaling mindset, because without it, everything is basically impossible. Because you're not going to be able to build a track record for brokers to take you seriously, right? It's going to take you a decade to build a track record. You're not going to be able to come up with the money, because even if you save $50,000 a year or you leverage your HELOC, you're not going to come up with $1 million in the next year. It might take you a decade. And so all these things that we're asking people to do with a single family house investing mindset are basically impossible. But once you shift that mindset, right? When you think about scaling, like Ben Hardy, the co-author of Who Not How, brought out a book called, I can't remember, like The Art and Science of Scaling or something like that. And he shifts the scaling things so much. He basically says, well, what are your 10-year plans? Do you have 10-year goals? And you're like, oh, and you're an ambitious guy, and you do whatever it is. I want to build $1 billion portfolio. Cool. What would need to happen for you to do it in 3 years, not 10? And you're like, well, hold on a sec, right? And what it does is it shifts your mind.
Yeah.
Because most people have a very sequential thing. I'm going to do this first, and then I'm going to do that, and I'm going to do that, I'm going to do this, and therefore now I'm at 10-year plan. And so what he says, how do you collapse that? And when you collapse it, you have to throw everything out the window. Your current approach is not going to work. And a scaling mindset is exactly that. So the biggest hurdle in the beginning is to believe that you can scale, and you kind of adopt this mindset about building your team, aligning yourself with professionals, with advisors, with partners, using other people's capital, and being open to that. I think that's the biggest hurdle. And then the next hurdle is more tactical, and it's simply just doing your first deal, kind of like you did and like I did. And the tactical part is super easy. Tactical part is all you're doing is you're making offers if you're the deal finder, right? You're analyzing deals, making offers. And if you're a capital raiser, you're going to be talking to investors. That's it. It's super boring. And you do those things, and then one person raises money, one person does the deal, you put them together, and there you go. The next hurdle, though, after that, again, a scaling mindset, is a lot of people have, once they do their first deal, they have a one deal at a time mindset, which is better than a single family house investing mindset. But when you ask them, hey, what are your plans and how do you plan on scaling? They almost always answer, well, I'm going to do another deal like I did last time, but a little bigger. Yeah. And that is not a scaling mindset. So we actually teach our students, what does that mean when you want to build and scale a syndication business? So it's not like, how do you scale your mindset and do a deal, but how do you actually scale a syndication business? And that involves things like longer term planning, creating a pro forma, a P&L, understanding what a mature syndication business will look like, and creating a hiring plan. What does marketing look like, right? You're going to you can raise $1 million or $2 million or $2 in raising money one-on-one, and you should, but if you want to raise 10, you're going to have to go online. What does that look like? What kind of revenue can you bring into the business? How do you reinvest that revenue in marketing and people? And the people who approach the syndication business from that mindset scale very rapidly. And the syndicators that do a one deal at a time will scale, but vastly slower.
It's interesting, Michael, because it's like thinking about it in simple. I'm a simple man, simple terms, right? You either think like you're a CEO growing a business. It's like, okay, what team do I need? What's my business plan? You look at things like traction, EOS, and about like how to run a more effective company. Or you're thinking like a single family home operator on a larger scale, one at a time, let's do it right. See how much I can do myself. Don't take too many risks, go a little bit larger, just marginal growth and everything like that. So I like the comparison for me, going back to the ESBI quadrant, maybe that's one of the themes today, is thinking like a B quadrant business owner versus an S quadrant sole proprietor.
The thing is, I want to be in the I quadrant, and to some degree I am, but maybe like you, I'm too young for the I quadrant. Okay, I'm 54 years old. the question I get somebody, hey, Michael, when is enough enough?
Yeah.
When is enough enough? And to me, well, frankly, I mean, it's not about the money anymore. It's about the experience for me. Like if I I love to learn. So my MO is to learn something, and hopefully I can accelerate this process by doing the things I just said versus, doing it for 10 years myself. Well, once I learn something, I like to teach it. Okay. I learn something and I teach it. And, and teaching is like that. What I am a natural born teacher, but if I have nothing to teach, then it makes me very sad. So how do I get more stuff to teach? I got to learn more stuff myself so I can teach more stuff. Yeah. Well, and there's nothing wrong with staying where you are. I mean, there's some people are like, dude, I am so happy. I don't want all this complexity. And I am perfectly happy sitting on the beach, time with my family. Super cool. For me, my playground, Matt, is business.
Yeah.
Like I want to, there's adventure. I want to experience adventure in life. And a lot of people do outdoor activities or they have drama relationships or whatever. We all have, some people like adventure, not drama, but adventure. And my playground is business. I thought about this actually this morning about the stuff. So
I like that.
If I'm not developing and I'm not learning, then I'm stagnating and that makes me sad. Therefore, how do I then continue learning? If I will continue expanding so that I learn more about business, as long as I don't sacrifice my quality of life. Like I don't want that. I don't want to grow and then the wheels come off in my personal life because I'm now working 60 hours a week and I really wanted to only work 20 hours a week.
Yeah, right.
But if I can work 30 hours or 35 hours like they do in France, okay, and I can now run a very large business or multiple businesses because I'm putting leadership in place, well, why not? Right? Why not? Now I'm experiencing new things and I'm growing and I'm not getting bored and I'm learning new stuff. So my thing is I want to continue learning and expanding, but I don't want the wheels to come off in my personal life.
I love that. I find that my business, my real estate, all those things, they decouple a bit time from my business. Not that I'm not one of these folks like he talks about, Rich Dad Poor Dad, of like wanting to just completely retire at my age to go sit on the beach and drink Mai Tais. Guess what? I've tried that. I got bored after like the second day. There's only but so much chilling you can do, right? I feel like I want to be productive. But real estate investing has given me access to my time that if I need to take time in the middle of the day, I can decouple. It's my business that is a joy to build. As I've grown and scaled, it's given me that I can choose to be in my business or I can choose to take a day off or take a whatever or just stop or just shut down at a certain time or whatever and work on my own terms. Maybe work on the weekends, maybe work because I'm working for me so I can put in the time that needs to get put in to grow when I choose to. Does that make sense?
It absolutely does. And I think you used the word choose and choice or option a few times. And I think that's the difference, right? Because here's the thing. You and I are probably working as hard as we did in a W-2 job. I mean, but we can't help ourselves.
I work harder now, man. I was a slug when I worked.
And so it's not, and I've observed everyone who does their deal and becomes financially free, they don't work less because, right? In fact, they'd have a bit of the opposite problem. They work a little harder. But I think the difference is, like you said, you're working your own terms, you're building wealth for you and your family, and you do have options. Like if someone wants to unplug for 2 weeks or 30 days, they can.
Yeah,
they can. And again, they might grow bored, but that's up to them. But when I was at my software job, I didn't have those options. I didn't have those choices, right? If I stopped working, the money would stop flowing. And that didn't really give me the options that I wanted.
It's funny, Michael. I used to tell people like, I want to start my real estate business. I want to invest in real estate. Why? Because I hate my job. I'm like, dude, if you hate your job, get a new job.
Get another job.
Just get another job. Get a job. There's a lot of jobs out there. Get a job you like. Don't get into real estate investing because you don't want to work or because you don't like to work or because you think that it's not a no work business. It is certainly plenty of work to do. I work harder now. I didn't give a shit when I worked for Ingersoll Rand. I worked as little as I could. Now, because I care, I work as hard as I can because I care about what I do and it brings me joy to do it. So there you go. So now we're preaching to the choir. Everybody. All right. I want to pivot with you real quick, Michael. What's great? I know this is kind of like a loaded question. Today's commercial market has a bit of its ups and downs, not just multifamily, but in general in commercial. What is great about today's commercial market? The opportunities, greatnesses you see in today, getting towards the end of 2025 that you see in today's market?
Well, it's interesting that using commercial in general, and we have traditionally been focused on multifamily only. But what I've observed, and I say when I've observed, probably since 2005, when I knew about apartments because I took a class in 2006, I knew about single family houses. And then, the recession, you saw what happened to single family houses. You saw what happened to retail. Then COVID came along. You saw what happened with office buildings, to some degree retail. Like there's these different asset classes, and they're in market cycles, and they're many times similar, but other times not so similar. And so really, I think developing a bit of an awareness of different asset classes, I think, yeah, just in hindsight, just sticking with one asset class is both a strength and a weakness at the same time. It's a strength because you really want to get good at doing one thing. And there's this thing called shiny objectitis, which used to affect me. And so if you do too many different things, you actually don't ever become good at any one thing.
Yeah.
On the other hand, being a little flexible with the kind of commercial real estate that you're doing, and at the end of the day, you're still managing a piece of commercial real estate, whether it's self-storage or multifamily. It's like to say a lot. It's the same thing but different. It's the same thing but slightly different. Okay, so why did we not look at self-storage, right, or light industrial or something like that? Why don't we do that? Why don't we pay a little more attention to the market cycles? And if multifamily is super hot, why don't we sit this one out? What's up and coming right now? Like, for example, not that I'm going to, but offices is so hammered through COVID, which is now 5 years ago.
Tempting, isn't it? It's tempting.
It's tempting, and you see a lot of institutional money going into office. You're like, what do they know that I don't? Right. Well, maybe there's some kind of opportunity. And they started this probably a year ago. Billions of dollars went into office space. And now literally like 2-3 months ago, these huge companies are like, yeah, guess what? This virtual work at home crap, no longer allowed.
Yeah.
You better go in the office or you're fired.
And they're going back.
And they're coming back. So did these institutional guys know this? Did they, in fact, maybe have something to do with it, Matt?
Sure.
I think they did. I bet you they made some phone calls. I'm about to place some billion-dollar bets. Elon Musk, why don't you tell everyone to come back to the office? And I bet you this was no accident. I'm just saying.
I think that too, and I think that they started to analyze productivity of employees for companies that they also don't care too much about for the employees. That if they're working from home, their job is going to be, okay, let me find how to get my job done for the minimal amount of hours put in per day, right?
Yeah.
I've had employees from my company that didn't make it very long that I could tell had that mindset too. So it's managing an employee when they work from home, if they don't have the affinity and the work ethic, is very tough to do, because they can certainly find ways to skirt their obligations and put in the absolute bare minimum amount of time and everything like that. So I get it.
These institutional investors, they have access to data. They're super smart and sophisticated. The way they make money is they recognize trends, right? Yeah. Both coming and going. Another trend is buying businesses, for example. That's another trend, and I have observed that a lot of our peers have started to do the same thing. And and why is that? Well, it's because we have so many baby boomers that are retiring. And I don't know what the stat is, but it's like 80 or 80+% of businesses that have been started by boomers that are very successful, making millions of dollars of profit, are never going to be sold or transferred. They're going to be shut down.
Yeah.
They're going to be shut down, right? The owners, there's no one in their family that wants to run their dump truck business, okay? There's no employees they feel they can run the business. For some reason, they don't want to go through the trouble or think they can sell their business. They think there's no value. So you have all these successfully, highly profitable businesses that are basically for sale, okay? Or not for sale. They're all off market. So there's huge opportunity to get into a whole new different asset class and have nothing to do with real estate at all.
Yeah.
And, we're starting to pay attention to all of these things a little bit and going, why don't we expand our horizon a little bit and figure out, well, what's the next 5 to 10 years going to bring? Yeah. And where do we want to get into and maybe catch where multifamily was in, 2018, for example, which was definitely in an upswing at the time, and ride that wave for 5+ years.
So to summarize it, you're seeing major changes happening in certain things. A lot of it pointing back to the boomers or pointing back to the real changes that COVID caused. A lot of the boomers, I think, were exiting multifamily about a decade ago, early 2000 teens. And a lot of folks like you and me I bought multiple properties off of boomers in that, like properties that had no Google pin drop, no Facebook page, no website or whatever for the property, just modernized things that a younger person like you or I would think to do automatically to get with to air quote, get with the times, right? I think most of that well is dry, but a lot of those boomers that used to own those properties, their brother-in-law owns, like you said, the dry cleaner, the laundromat, the HVAC company that is now ready to be scooped up too. I love it.
Well, we didn't talk about multifamily. I'm not poo-pooing
there. Tell me what the opportunity you see in multifamily.
Yeah, I mean, the advantage of commercial real estate is it's a real wealth building. It's a wealth builder. It's a wealth builder because it's got cash flow. It can appreciate if you increase the NOI, and you have humongous tax advantages. For example, another asset class like buying businesses, while it generates a lot of cash, which is super cool. It's obviously a little harder to sell, so it's not nearly as liquid. Also, it's a little riskier because you can just see it that the kind of loans you get for a business is all recourse versus non-recourse for multifamily.
Oh yeah,
and there's really no tax advantages, right? So it's a totally different asset class. So within real estate, the question is, what should one invest in?
Yeah,
and so I really do like multifamily. And looking back 2.5 years ago, we kind of sensed that we were at the top of the market cycle. I mean, I certainly did. Did it stop me from doing deals? No, because I have happy years. I always have happy years.
Yeah, me too.
Right? And so, but our friend Brian Burke, of course, he started he'd stopped buying deals and started selling deals because he's a little more mature than we are, and he had a little more perspective on the market.
I think he borrowed Michael J. Fox's DeLorean. Honestly, he sold everything. That guy, I look up to Brian Burke, and I've had him here on the show. The guy, right when they did the first interest rate hike, he put everything he had on the market, because he saw what was coming, because he's a safe.
And that was probably the trigger. That was a trigger, because the problem is the market has been going up since 2015, arguably even before then, right? So people are like, oh, the market's hot. They would have missed this entire ride. Yep. Okay, including, by the way, going through COVID all the way to the height of 22.
Yeah,
they would have had 7 years. I mean, arguably the best years in multifamily history. I mean, it was wild.
Yeah,
and so you can't, just because the market's going up doesn't necessarily mean you should stop buying. Okay, but that was, in hindsight, a trigger. I was definitely that interest rates going up in response to what was going on, the inflation, and so. But be that as it may, what I'm saying right now is the risk-adjusted return, the spectrum, is totally different than 3 years ago.
Mm-hmm.
Where 3 years ago, we were at historically low interest. So the outlook was obviously up. Okay, up. Well, that's bad. That's bearish. And we had historically high leverage, 85% loan to cost, not loan to value, loan to cost, which includes you could get loans for construction, which now we can't. So now you compare to the now. It doesn't matter where the interest rate is. Okay, it's high, but who cares? The outlook is stable to down. Most agree it's probably down. Well, that's bullish. Okay, interest rates going down is bullish. 3 years ago it was bearish. Also, the leverage we're getting right now is 75% loan to value. The leverage we're getting is vastly lower than it was 3 years ago. Also, much less risky. Yeah. Right, and then you couple that with prices still being down about 30% from the height of the market, where in some cases you can buy below replacement cost.
Yeah.
And then you couple that with the outlook for the multifamily space, now that all this new crap is out of the ground, and it's almost being absorbed in almost every city in the United States, where all this new stuff came out from all this free COVID money, and it kind of hammered us for a little minute for Class B and Class C, which I did not project that. I thought it might be impacted a little bit, but it actually hammered us pretty good on the rent increases.
Harder than most people thought.
Harder than most people, and you're affected by that property in Kentucky, and others we saw in Atlanta and Dallas. But for example, Dallas is almost all absorbed. In fact, rents started ticking up again, the first time in 2 years. Mm-hmm. And Atlanta is projected to happen sometime in Q4, maybe Q1, where all that new stuff has been absorbed. And now that will naturally migrate up, the rents will migrate up to Class A levels, leaving that gap between Class A, Class B, and Class C. Mm-hmm. And here's the thing. There's no permits being pulled for apartment buildings. None. Mm-hmm. It's too freaking expensive.
I think well, let me bottom line something you're saying about multifamily. People don't see this, and I think this is like, my father-in-law gave me a great adage, which I probably quote him at least once a week: observe the masses and do the opposite. Right? That there is where
Warren Buffett says. Right? But it's so hard to do because we don't invest with our heads; we invest in our emotions,
in our hearts.
That's so hard.
Yeah, like everybody I talk to is telling me multifamily is bad right now. Well, yeah, it's stuff that got bought the last 5 years is facing a lot of headwinds because it got bought on, a 3 to 4% interest rate, and the market's not yielding that anymore, and rent growth isn't what it used to be, and all the things, right? That said, you said something interesting that multifamily is down 30% nationally, right? That sounds like a good time to buy, not for nothing, right? So I think that for those with the courage that are looking to grow and scale themselves and to get into another, like, I believe that right now is one of the best times to buy multifamily, because you're going to buy at a rate likely that's higher than what you would like to pallet. But guess what? The good news is that rate's going to go down over the next couple of years, and multifamily is likely to go back up as rent growth kicks back in, and as we work through the glut that's happened through multifamily. So if you buy the right asset that does this wacky thing called cash flowing the first day you buy it, right? If it does that, then you can hold out through maybe a down cycle, even if we have a recession, whatever it may be. I had Jay Scott on the show yesterday, and he was talking all about different recession stuff and pulling out his crystal ball, because he's got a good one. Given all that, given the data that I've heard, I think that multifamily is actually a good space to be in for new acquisitions today. Would you agree?
Well, I would agree with that, and I'm a little more cautious than I maybe wasn't before.
Yeah.
But I would agree with that. And by the way, I got Brian Burke to agree to this on my podcast 2 months ago, where I got him go on record saying right now might be the best time to buy. Might be. But before he was saying, no, this is awful. Run. Don't invest in multifamily. It's awful. And I got him to agree that it might be, because of the similar data that he's seeing as well. So it might is pretty strong coming from Brian right now.
Times are changing, right? I mean, there's more to talk about on how to scale and how to get into all commercial real estate ventures, including, multifamily and maybe other commercial ventures that are out there, Michael. I know that you're working with Best Ever on a webinar coming up, and I want to give people the link to get to the webinar. And by the way, it's just bestevercre.com/scale. What, for those that are going to be joining you on that free webinar we've got coming up on October the 21st, what would they expect to learn from you on that webinar about getting themselves to the next level?
Yeah, I mean, this was a great intro to what we're talking about here. We want to go deeper on.
Yeah.
If someone wants to scale with commercial real estate, and they want to understand what a scaling mindset looks like. They want to learn how to find deals, how to analyze deals, how to raise the capital, how to put a team together.
Yeah.
That's what we're going to talk about. And I think we're going to call it like Apartments 101. It's like an introduction to, syndication. It should be called Syndications 101, right? Mm-hmm. Because you can raise capital and buy anything. But it does require a scaling mindset. So we're kind of going to go deep on each of those things, especially if you have done a rental or you've done a flip and you're kind of scratching your head like I did a long time ago, going, my gosh, I can't buy another rental or do another flip because I can't get there. How do I get there? And hopefully this training will answer that question.
Well, I think the tools correlate, right? So what you're going to teach in that free training, if people want to learn how to scale and try on, if they want to get into the $1 trillion world of office space because they see office as an opportunity, you're certainly got to raise capital. You're certainly going to put a team together. You're certainly going to have to build a B quadrant business around it. And so I know that a lot of things we just touched on today, I wish we had more time together here. A lot of things we touched on today are going to be in that webinar. So I encourage the Best Ever listeners to go to bestevercre.com, your favorite website in the world, bestevercre.com/scale. So go to that website, guys. Sign up for Michael's free webinar. I will be there. I'm super excited to hear what Michael has to say. So I'm going to pick up some tips too on scaling my business, because I've got a medium-sized company. If you're listening, got a medium-sized company too. But guess what? If you want to grow and scale, there's always opportunity. There's always new ideas. There's always new places you can get. So if you're that operator Michael and I had talked about that's got the small duplexes, triplexes, and you're racking your brain and you see the opportunities and you want to get into the next level, that webinar is for you. And also, if you want some tools on growing to the next level for wherever you're at, that webinar is for you too. Michael, I'm excited that you're going to be spending some of your time delivering some value to the Best Ever community with that free webinar. So thank you for that, for contributing to the Best Ever community that way.
Yeah, it's my pleasure. And look, I feel very strongly about this. Is why I wear this shirt called Freedom on it.
Yes, sir.
And if I can talk someone out of doing another flip or another rental and actually really scale, so I appreciate the opportunity, Matt, to speak to your audience.
It's excited to be working with you. Michael, if folks want to, aside from going to bestevercre.com/scale, aside from doing that, how do people get a hold of you if they want to reach out to you, your company, pick your brain, talk shop, that kind of thing? How do people reach out to you?
Yeah, I think a great way is to go to that webinar. You get to know each other a lot more, and I'll give you some handles as well. I think in the meantime, probably the best jumping off point is maybe thefreedompodcast.com, which is kind of our homepage for our
Nice.
podcast as well. We talk about a lot of similar things, but like I said, similar but different. So it's thefreedompodcast.com, and there's a bunch of free resources on there as well, in addition to the podcast. So that might be a great way to get a hold of us. But we're also very active on social and YouTube as well. So not that hard to find.
Michael Blank, Blank. Guys, after you've listened to all the best ever podcasts that are out there, all thousands and thousands of them, go over and listen to the Freedom Podcast as well, because I've been on Michael Blank's show as well. He's a great interviewer, brings on a lot of great talent as well, a lot of names you've heard of, and draws out some really great conversations from folks. So make sure you check that out too. Michael, I enjoy our friendship. Thank you for joining us here today at the Best Ever CRE show. And I appreciate you really having a great, authentic conversation. Tell a bit of your backstory and stuff like that. Really good convo. Best Ever listeners, great conversation with Michael. I hope you guys enjoyed it. I really got a lot out of that myself. Take a minute one more time. Here it is. bestevercre.com/scale. Be there, be square. I will see you there. Until then, guys, thank you for listening to this program. As I said in the beginning, please like and subscribe to this program. Please share it with a friend that's got that duplex, triplex, quadruplex that wants to go to the next level. Send them over to that website too. Have them sign up for the webinar. Until then, guys, appreciate you listening and have a best ever day.